In this week's update, inflation the highest year on year in 41 years. The Ukraine war has changed the outlook significantly. Growth stock ratios roll over again, and gold in a big intraday reversal. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Well, Friday night in the States with the inflation numbers changed everything, and it really was a tumultuous session. So it's important to step back now and look at what it all means. But look, just before I start, I just thought I'd point out a couple of things that, I get the odd question about. I've been doing these Sunday videos now for about 16 years. I do them nearly every Sunday of the year, so I do them for a purpose. Otherwise, I'd be a bit crazy. So I thought it'd be helpful and productive to create a page that outlines how best to use the information that's in these videos every week and why all the indicators that I use are important. Now that's a task for the next few weeks, so we'll get to doing that. But I thought I'd just touch quickly on why I do it for anyone that hasn't seen too many of these. Firstly, the media is just so misleading, and their treatment of the market or their examination of the market is just so superficial. And it has investors doing the wrong thing most of the time. And if that's your information source, then you're doing the wrong thing at the wrong time, and you're doing it often. And that's obviously not very helpful. Secondly, I'm seeking to provide a completely unbiased perspective which allows investors to make more informed decisions. The better equipped you are with a more accurate interpretation of what the market is saying about where the money flows are going, then you're in a position to make a more informed decision. Beg your pardon. I've been doing this now for 35 years. I've developed a very large knowledge base, but in particular, the ability to interpret the signals from a diverse range of areas, not just the stock market, but credit markets and currency markets as well. And over time, a number of people have gained enough confidence and trust in what I do. They want more, and so they join one of the memberships. So, that's it. It's pretty simple. It's a mutually beneficial exercise for the benefit of everybody. So anyway, more on that in future weeks. And in particular, why the relationships that I examine are the important ones to look at. I think that's the most important thing. All right, let's look at the inflation data. This chart doesn't need a lot of examination to understand it. We've got the black bars is CPI year on year. So that's a particular month compared to the month in the prior year. And then the red line is the core CPI, which it strips out food and energy, which to me is kind of crazy because, they're the things that are most important to people. But anyway, that's how they do it. So you can see that there's been, since the start of 2021, there has been a significant move higher in inflation. Now, people have been expecting it for 5 to 10 years and it never came. But, now it has. And you may recall that since the start of this year, my assessment was that because we had these very high increasing and high levels of inflation in the first 6 months of 2021, that I expected some sort of moderation of inflation kicking in, April, May, June of this year. And so the comparative year-over-year numbers would start to tail off again. And therefore the Fed would be able to back off, the equity markets would cheer, and everything would be fine. But of course, what has changed that? Well, what's changed that is the Ukraine-Russian war, because that sent energy prices and food prices through the roof, which is just filtering now down into absolutely everything. And so that has been the game changer, and that has prevented that moderation in inflation that probably would have occurred. And we're now seeing inflation still accelerating, and that has what is what's really spooked the market, particularly on Friday night. So I think you've got to step back and acknowledge that what was probable is no longer going to happen, at least in the short term. And so we now need to start to look at the market through a bit of a different lens. All right, so the major issue, for me, is it's not inflation per se. That's not what's causing stocks to sell off. It's how the market's perceiving where it's going to go, where it's going to lead, how many rate rises the Fed is going to have to bring down to get inflation under control, and how far they're going to push the economy possibly into recession. The contributors, of course, US energy was up 35%. Now this is the figures from Friday night for the month. Food, housing, commodities are all setting record increases month on month, and this is a heck of a lot of this is due to the situation in Ukraine, because they're just such major exporters of so many different things. I mean, it's just blown me away how many different areas they are the major or second major exporter of that particular commodity. So this is going to spiral through the economies around the world. And of course, unfortunately, people on the lower end of the income spectrum are going to be the hardest hit. That's for sure. And so the biggest proportion of the population is really going to be struggling to spend. So I think discretionary spending is certainly going to be under pressure. Now, when you couple that also with the fact that interest rates are rising, so the cost of credit is rising, and a lot of people on middle and lower incomes, rely on credit cards to get through from one month to the next. So they're going to be paying higher interest rate increases as well. So you can see very easily that the consumer is really going to get squeezed. And, until there's some sort of resolution in the Ukraine, it's really hard to see what's going to be the circuit breaker to this inflationary increase. Now, last week I said that all we have are probabilities, and right now it pays to be conservative. Now, I was still hopeful that we were in a bottoming process, but now after Friday night with inflation accelerating again, you've just got to recognise reality and back away from that that thought. So what does conservative mean? It means, in my view, I never want to go defensive. So in my view, I always look around and think, well, what can I do? What are the positive things that I can do? What is likely to do well if economies get challenged, which they are, and consumers get challenged, which they certainly are? Then what are the sectors that are going to do well? And I talked about that for a little period last week. They're relatively obvious: energy, agriculture, commodities, and stocks that have got highly probable earnings per share growth and pricing power. So if their cost base is rising, they can pass those costs on to the consumer. And only a relatively modest portion of companies can do that. A lot of companies are in a competitive environment where they really just can't do that to a sufficient extent to protect their margins. Now, these sectors are not just all going to run one way, although energy's been doing a pretty good job of that in the last couple of months. They will have their ups and downs, but it's definitely going to be a case of 2 steps forward, 1 step back for those areas. So they're the areas that you want to be targeting. You don't want to stay with the same old, because there's a very good chance you're going to get beaten up in the next, whatever period until we get through this. And of course, we will get through this. So there's really no question about what's coming. This cycle will run for a period of time. We've certainly been running longer than normal. At this point in time, we're almost up to 6 months. Bear markets always pass. When you're in a secular bull market, which we are, and I certainly want to put some focus on that, because naturally, some people start raising the question, well, is this the end of the secular bull market? And I can tell you that, we're several years away from being able to assert that. So bear markets always pass. And great stocks that have been beaten down because people have panicked always rebound spectacularly. So that is what's coming, and that's what you need to focus on, not the red on your screen every day, which gets you into a negative frame of mind. You need to focus on what's coming. So for investors at the moment, the most pressing task that they've got is managing your psychology. That's it, point blank. It's keeping your head straight. And sure, it's pretty tough out there. And if you want to try and keep your head straight, you've got to stop looking at your computer screen so often. Just look at it, less, and maybe don't look at the bottom line. Just look at the charts. So keeping a sharp and very realistic perspective is absolutely vital. And I've been feeding members of both my services a steady stream of that perspective and information all year. And I think I know it's helped them an enormous amount, because, they send me emails and tell me that that's the case. It's just so critical at the moment that you're exposed to that sort of perspective. You've been copping the pain. We've all been copping the pain. So we have to ensure that we stay in the game in a way that we can get the gain, because the gain is coming. It always will, and it's certainly going to happen again this time. And is it next week or is it in 3 months' time? No idea. I'll just following along with what the market is showing us, but it certainly is coming. All right, before we go to I'll do the American. I'll do this slide first, and then we'll look at the charts. So the S&P fell 5.1% for the week. It's not the biggest down week of the year, but it's certainly one of the worst weeks of the year. But on my sort of cursory glance, I think it's probably been the worst 2-day run of the year, because we had a big gap between Thursday and Friday, as we'll see. But look, it's not all bad, because there are sectors that are doing well to, relatively okay. So there are areas that you can be productive in. Now the US dollar index shot up, of course, with those inflation numbers back up to 104. The expectation is the Fed's going to have to do even more on interest rates, and that was positive for the US dollar. The yield, which had been coming off, had got down into the 2.7s, shot right back up again, almost to 3.2. So that's a major step change, and you can't ignore that when it happens. This is a confusing one. The VIX only went up to 27. When I got up on Saturday morning and saw where the indexes had finished, I expected to see the VIX sort of 35 at least. So to only go from 24 to 27 was a real surprise, and I don't know how to interpret that. So I'll just leave that one on the sideboard for the time being and see what happens early next week. However, what did change, and I guess this is logical, is that the 10-year, 2-year spread, which had been up around the 0.3 mark, has now fallen quite sharply and is now almost back down to 0, which puts the possibility of recession back on the table. So let's go in and look at some of the key charts. I just want to show this chart. This is important. This is HYG. It's effectively the junk bond market, the low quality credit end of the bond market. And you can see we were falling away until we got quite a nice rally in May, kicked up quite nicely, and this was one of the factors that, among many others, that influenced me to think that the bottoming process had started, because the market, this was a vote of confidence in the markets in general, because the pressure on the low end, the low quality end of the credit markets seemed to be coming off, and that's why HYG rallied. But you can see that it then started to fall apart again, and look at Friday, look at Thursday and Friday. It's come apart really quite significantly. Look at the volumes associated with that. Now let's have a look at what happened back in with the COVID crash. We got down here to 68. I can't tell you the speed with which this is falling, that we couldn't get back down to this sort of lows. And this sort of thing in the credit markets are very disruptive. Even though we're not trading this, it's saying that there is the potential for instability in the credit markets, and it's the credit markets that allow businesses to operate. The vast majority of the smaller end of the business market rely on this market functioning well and being able to provide the credit. It's I think I read this the other day somewhere, it's the lubrication that makes it all work. So if we get dysfunctional in the credit markets, then that just has ramifications across the board. Okay, let's take a look at the S&P. And I'll start first of all with, this is the big picture. So I've been showing this now for a couple of years, and I last looked at this in detail when we had the COVID crash in 2020. And I looked at, during secular bull markets, the last 10 cyclical bear markets. So they're the shorter, these ones, that one there, this one here, etc. The average length was around 6 months, or 4.2 months if you excluded 1981 to 1982, but let's not cherry pick them. So the average length of a cyclical bear market is 6 months. And the maximum length, if you exclude 1987, is only 3 months, or since 1987 is only 3 months. So they tend to be short and sharp. Now this one is pressing on now for 6 months. And after Friday, probably no immediate end in sight, and we could form a new low. I hope that's not the case. I hope that the market has just reacted badly to Friday night and starts to look ahead, and we don't form new lows. But you've got to at least entertain that possibility now. So the total bullish months in the last 70 years were 541, and the total bearish months were 59. So roughly only 1 month in 10 is bearish, and that's over the last 70 years. So you've got to keep that perspective in mind. So if you're experiencing a lot of anguish at the moment, then you just got to know that a much better time is coming. And I posed the question back in 2020, what are the odds that the cyclical bear market will break history? And I concluded that the odds weren't very good, and turned out they weren't. And the last one only lasted 5 weeks. But that one was for a very specific set of circumstances. We are now in a different environment. In 2020, the long-term interest rates were not turning up from a 40-year bear market in interest rates going down. This is now a very different environment, but that's history. So take it for what you will. Now, what constitutes, if you look at what constitutes a secular bear market, we'll just look at the two moving averages, the blue and the red line. Yeah, they have their ups and downs, but they're just going sideways. That's what a secular bear market looks like. This one. Bit more volatility, but effectively just going sideways. Now look at what those moving averages do in a secular bull market. They consistently rise, and the blue line is consistently above the red line. Where are we at the moment? We're still in that orientation. So there's no way that you can say that the secular bull market is over. For a start, it's way too soon. We're about 8 years too early based on history, and there is no confirmation. This would have to go on for many, many months for these moving averages to roll over. And even then, you'd need to add on a few more months after that, to be sure that we weren't going to get something that looked like this, or like this, where you just basically dip you dipped so that they're equal, and then they head off again. So I think, based on probabilities, which is all that we've got, we don't have certainties, we don't have guarantees, we don't have absolutes. All we've got is probabilities, and at the moment we're still in a secular bull market, and we're in a cyclical bear. It will pass, and that's the reality. All right, let's look at the S&P. You can see we've now well and truly turned over. We rallied back to test the breakdown, and then look at Thursday and Friday. They're both long range candles, is the first point. The second point is they closed on their lows, absolute. The third point is look at this huge gap between the close on Thursday and the open on Friday, and it just traded down throughout the session. That's pretty negative, and so you've really got to say that lower lows are at this point in time likely. So that's just the reality of the market that we're in. Okay, let's look at some key spread charts now. Right, we'll start first of all with the Nasdaq versus the S&P. So Nasdaq much more heavily growth orientated than the S&P, and you can see we've rallied back. I think over the last couple of weeks I've said we need to break this peak on the ratio. So this is the Nasdaq divided by the S&P. And a falling ratio means the Nasdaq is underperforming the S&P, and now it would appear that we're heading back down again, and certainly that was the case on Thursday and Friday. So as much as the S&P fell, what you conclude from this is that the Nasdaq fell even more. That's what that's telling you. This is consumer discretionary versus consumer staples. It's the same situation. Now, this was looking more positive because we did form a higher high, but to get a new uptrend, you've also got to form a higher low, and you don't form a higher low until you break this peak, because you don't know that you've got a lower low. So at this point in time, it may well be, in fact, I think it's likely that we've got a higher high, but we're not going to get a higher low, that we may well just go straight down. So consumer discretionary against consumer staples, we're still in this very steeply downtrending channel, and while ever this is happening, then you've got a cyclical bear market on your hands. This is the Russell 1000 growth versus value, also turned over. Money is not going into growth stocks, and while ever that is happening, the cyclical, a new cyclical bull market within the secular bull market will not materialise. This is small cap growth versus value, a little bit indeterminate. So money is either flowing into or flowing out of both at a roughly equivalent speed. So not much happening there. Okay, I think we've doubled up on that one. All right, let's have a look now at the sectors that are doing well. So let's look at the energy sector in America. And just a point that for those that don't trade in America, you've got to look at America, because America sets the scene for the rest of the world. The rest of the world follows what the US sectors are doing. So even though you may not trade in the US, it's just critical that you understand what the US is doing, because other markets are just going to follow along. So we have to go where the money is flowing, and look at this chart. Look at the 200-day moving average, the shorter term moving averages, and where the price is in relation to them. Look at this chart in relation to the charts that we've just looked at. There's no question where some positive profits can be made. This is XLF, the finance sector in the States, and the big banks are getting beaten up. We've had a significant breakdown. Now that breakdown started to unfold in April. We've had a few little bounces, but now you can see a couple of quite emphatic moves and big volume on Friday. So all of the moving averages now for finance are rolling over. This is the industrials, which is it's a very, very broad-based index, but no question, it's rolled over as well. This is technology, really important for the health of a bull market. It's rolled over, and it's in quite clear-cut downtrend. Even healthcare hasn't, the moving averages are only really just starting to roll over now, which is what you'd expect because healthcare is more defensive, but it's also under pressure. This is consumer discretionary. This is, the top two, Amazon and Tesla, form nearly 40% of this ETF. So it's not really that representative of of what's happening in the broader consumer discretionary area. But if you drill down into some of those industry groups, they all look pretty ugly. So that's consumer discretionary, and it's pretty emphatically pointing to the downside. This is metals, so this is another positive area, and this includes coal, aluminium, gold, copper, and steel. And these are the companies. They're the major components of this ETF. Look at the 200-day moving average. It's still pointing up. The price is still above it. So energy and commodities have been holding up really well. And if you look at DBA, which is an ETF that gives you a good indication of what's happening in the agricultural sector, then that is also still looking fairly positive. So it's pretty obvious where the positive money flows are going. Oh, and this is XRT. So this is a retail ETF that does strip out more of the impact of Amazon and Tesla. So it's in real trouble, and I think there's a lot more trouble coming because the pressure on the consumer is really only just getting started. Okay, that's the relevant sector charts. Let's have a look. This is the 10-year, 2-year spread. You can see we went negative for just a day or two in April, and everybody jumped up and down and said recession was coming, but we then spent the rest of the time bouncing quite healthily, but that just fell apart on Friday with that inflation number. There's the VIX over the last 6 months. You can see we've been trading down around the 20s as a low, which in itself is a bit elevated on long run history, with the odd spike above 30 and up to 35 and even close to 40 on an intraday basis. But you can see we had a kick up on Friday, but it's just not as big as I would have expected. But anyway, perhaps that's coming next week. And finally, this is the 10-year yield. Let's go back and look over the last 6 months. There you can see we had a dip, but then we started in the last week or two, we just started inching our way back up again, and quite a significant rise on Friday. If we look at if we actually look at the 1 day number, you can see that's just Friday, how much it kicked up. So that's the new reality that these inflation numbers have brought home, and you can pull the covers over your head or be in denial about what's happening, but that's the reality. And in the short run, markets aren't going to react well to them. But please just keep in mind the perspective of of what's really happening out there. Let's have a look at the US dollar. So you can see a lot of strength on Thursday and Friday, and that, of course, punctured the Australian dollar, which fell down under 70 and closed the week at just under 70. Now, looking at the Australian indices, we had two fairly significant down days, Thursday and Friday. It's almost certain that there's going to be more on when our market reopens. after the long weekend. Unless there is a sudden turnaround in the US on Monday night, that's going to be, we're going to see a continuation of this. And you'd have to say that the Australian index, the ASX 200, looks shaky. The 200-day moving average has rolled over. The price has been trading under it almost the whole time since January. So almost the entire year, other than this brief period here, it's been starting to trend in the negative direction. But even in Australia, there are some positive spots. This is the materials sector. Now, okay, dominated by BHP and Rio and Fortescue, and mining small cap stocks have been beaten up, fairly severely, which is what normally happens. But again, recognise that's what's normal, and they always come out of it. Now, I don't know when they're going to come out of it and whether they're going to go lower first, but if you've got quality projects in mining, and we've got some absolutely world-class quality projects that are cheap. Some are expensive, but some are very, very cheap. And, they're going to rebound spectacularly when the time comes. So that's what you want to focus on. Energy has obviously done extremely well, mirroring what's happening in the States. Finance has really been getting beaten up very, very badly. So, if you're a dividend investor in the banks, then, I don't know how much more capital loss you're looking at. So you need to be very clear about your purpose if you're in some of these sectors. Healthcare, it really took its hit towards the end of last year and has really just been tracking sideways for most of this year. So that's the Australian market. So just to recap, 69.87 was our dollar. Our index lost 4.3, with highly likely more to come. It's the worst week since 2020, and the banks actually lost 9%. That's a very, very bad week for the banks. Positioning, what do I mean by that? How much cash you've got, what you own, what sectors you're in, what's the balance of your portfolio. All those sort of things is really vital. If you're not positioned in things that are appropriate for you, then you're going to be feeling a lot of pain at the moment. It's really important to understand what it is that you need, and I've been putting a lot of time into helping members with, just getting their perspective straight on what it is that they need. What should their portfolio look like given the phase of this market? It's, as I said right at the start, this cyclical bear market will pass, and there'll be fantastic rebounds, but not if you succumb to your emotions. So your portfolio needs to be structured so that you can keep your head straight and get through this period so that you can experience the positives on the other side, and the other side is coming. Now, precious metals, gold, I think everyone knows my view on gold. It's been so frustrating. The case for gold has been there for several years. Gold, with an inflationary environment building and all the problems around the world, the fear arising from all sorts of things. It should have been a magnificent environment for gold, then it was just so frustratingly flat. But gold finally kicked up on Friday night, and we ended up, it was very volatile. It's very interesting because gold was trading around 1850 when the inflation data came out. It plummeted to 1826 and then immediately turned around and went up to 1872. So, intraday, gold was absolutely wild. So, when you see that sort of volatility, you can't be sure about what comes next when the intraday volatility is so high. So I don't know whether this is gold's time or not, but I do know that you can't ignore those sort of intraday reversals. We'll see. Anyway, the rising gold price and the falling Australian dollar has pushed the Australian dollar gold price up to 26.80. So that means, for gold miners in Australia that have got all-in sustaining costs of, $1,100, $1,200, $1,300 an ounce, 26.80, they're making a huge profit margin. So this really is an environment where we should see quite a positive response in our gold sector. I don't know whether we're going to get it. I don't have that confidence at this point in time. So we'll just have to wait and see. GDXJ and GDX finally showed something. So let's take a look at those charts. So this is, I'll just touch briefly on, so this is Bitcoin. We finished at 29,000. So, you know, it's been a huge downhill slide since November for Bitcoin. All right, this is gold on a daily. You can see the intraday volatility, huge. So that was a range of 26 to 76, so a $50 range is pretty big for gold. And if we look at it on a weekly, you can see there's just a slight positive orientation to the upside. And there's gold on a weekly. Let's look at GDXJ. So that's what gold miners did. Gold miners responded quite positively. So, you know, it would now appear that we're close to getting a higher high and a higher low. We're not there yet. We need to close up above this level. But certainly when you get this sort of really robust engulfing candle on big volume, the odds are that this continues to the upside. So maybe there's some light at the end of the tunnel for gold investors. All right, other commodities, copper. And this is encouraging. This is really encouraging. Copper managed to hold steady against the US dollar, doing what it did. And nickel at 12.33. I would have thought that was a session where base metals could have been really punctured. You know, interest rates having to go up to push global economies into recession, and the US dollar rising at the same time. Perfect time for the traders to get in and sell base metals, but they didn't. So that was encouraging. Crude oil, similarly, it actually went up about 30 or 40 cents against the US dollar. So some interesting moves or non-moves, if you like, in commodities. And when it comes to crude oil, when you look at the underinvestment, you look at global sentiment towards fossil fuels, which almost guarantees continuing underinvestment. The price risk has got to be to the upside, surely. And that's certainly what the sector charts are saying. There's spot copper, spot nickel, not a lot of change. So wrapping it up, we've got two choices here. We can buy into the emotion, which most people will do, the frustration, the impatience, when will this bear market be over, the despair if you're staring at the red on your screen all day, and end up making unfortunate decisions, dumping quality stocks at the bottom or somewhere on the way to the bottom. So that's one choice, and it's not a very good one. Or you can take a wider, much more realistic perspective along the lines of everything that I've talked about over the last 20, 30 minutes. So a more effective thought process is that all bear markets pass. There's just no question about that. And that along the way, and particularly towards the end, inexperienced investors just panic. They sell everything. They sell quality. They sell it for a stupid price because they're not thinking clearly. And they sell it to experienced investors who understand what it is that they're buying and understand the dynamics of the market. And that always happens, and it'll happen again. In fact, it's happening now. So how you manage your psychology through this period will dictate your wealth, because you can come out of this in a very positive fashion, or you can come out of it, very badly beaten up. And I've said it, many times in the last 2 years, 2020, from January to December, was my best year ever, including, the crash in February and March. And the reason that occurred is because I kept my head, and I understood what it was I needed to do. I cashed up quickly, not fully, probably to about 50, 60%, but I cashed up quickly, and then I utilised that capital confidently once the market turned. And 2020 was my best year ever. And, I'm expecting that something similar, it's always different, but something similar will happen this time. Okay, so the best things to do right now, most importantly, don't buy into the media narrative, because it will just completely mislead you. Don't panic sell, particularly if you've got some quality stocks. They'll come back. But holding cash equally is important, because you don't want to get to the bottom of this thing when it turns up and you don't have much cash. If you've got 5% cash, there's not a lot you can do with that. You've just then got a longer period to regain the ground. It's so much more productive if you've got, a bunch of cash that you can use. You need to get rid of poor quality stocks, because, they're not going to come back within any sort of reasonable time frame. And some of them won't come back at all. They'll go out of business. So you need to just bite the bullet. You might be down a lot, but if they're low quality stocks without earnings, without the probability of earnings in the next couple of years, then it's, probably all over. So get rid of them. Prepare your list of high quality stocks. And there are plenty of them. And they're the stocks that have got the the highly likely earnings growth, no matter what, recession or higher interest rates or whatever, their earnings are still going to keep growing, and they've got pricing power. And if you don't know what sort of stocks they are, then maybe you need to find someone that can help you identify those. And certainly I spent a lot of time in Portfolio Analyst, giving members ideas about those sort of stocks, the stocks that meet that sort of criteria. And that will be, an ongoing theme in coming weeks and months. Now, speaking of Portfolio Analyst, last week I covered, why a great story wasn't enough. It's just not enough to have a great story, but, the price goes down 80%, and most people will find it very difficult to deal with that. You've got to have momentum. So we covered what has momentum and what hasn't. And we talked about, portfolio balance. There was a lot on technical analysis, how to read the charts better so that you can get a better indication of where markets are likely to go. And we also looked at the danger of sovereign risk as well. There are always potentially problems if you're outside of the real tier one countries like Australia and America and Canada. There are always problems, and they come up too frequently for my liking to run the risk. So that was Portfolio Analyst last week. All right, that's it for this week. I know it's a long one, but it was a big event on Friday night, and you've just got to have a really sharp perspective about where markets are going to go from here. So I wanted to take more time to outline all that. There's the website address and my email address for anyone that wanted to contact me, and we'll see where we go over this next week. I'll be back with you next Sunday. Cheers.